All right, welcome everybody to our financial services Q&A session for this week. It's been a few weeks since we've had an update, Andrew. We've sort of got busy with a few other things, but we just had such good feedback from our clients and from the public that we thought we'd re-engage and start the series up again. So this week we're talking about wealth creation. So should have everyone's attention, trying to create a bit of wealth for themselves and their family. So we'll get in. I'll just share the screen. Probably should use the mouse, shouldn't I? See, you plugged it in for me. Share that one. And
there we go.
There we go.
I suppose the purpose of today is really just to go through some fundamental things that I think about when I deal with clients in terms of wealth creation, and thought I'd just step through that. It's not always about the solution, it's about the ability to be able to fund some sort of wealth creation exercise, which can be either through a vehicle of some sort, but also I think about other things that we do in terms of your home loan and your property, and it's a sum of all parts. So I thought today I'd just step through where I think about things, and fundamentally, in my view, it's your ability to actually have that mechanism to be able to invest. So we go to work, we earn an income, we pay for our living expenses, and often or not we want to be able to invest, but there's not always something left over to be able to do that. So rule of thumb for me is, first of all, if we're not saving, how do we go about saving and getting ourselves to a position where we can actually start doing some wealth creation? So that's where this sort of slide plays into. Wealth creation, in my view, is savings times your ability to invest that saving. And I know it's a very basic ideal, but it is something that you've got to get your head around when you're thinking about it.
I love it because it is back to first principles.
Back to first principles.
And at the end of the day, there's no point having fantastic investments if you haven't addressed that first principle, is that you need to have a net savings to go to invest. So,
and a lot of the time I see there's competing pieces of the puzzle that you need to get right before you actually start that investment process. Broadly, with your income, there's obviously your active income that you do through earning it through either your labour, the work, or your wages, and then there's the passive income, which is generated from investments. And ideally we get to a point where we like to, I suppose, have a bit of both while we're in an accumulation phase, and ideally at some point in the future, when your working life comes to an end, you've got enough passive income there to provide for you and your lifestyle. And that can be through investments, superannuation, it can be through property rent incomes, and dividends and so forth, and interest as well.
So earning income by sitting on the couch.
Sitting on the couch. Often when I catch up with especially young couples, and we're talking about how they can get ahead, and one of the pieces that I like to challenge and talk about is the ability to improve your employability. What are you doing in the first place to educate yourself, or to just get yourself to that next stage with your employer, so you can go up the pay scale and such. And I think it's really worth considering. The other piece I like to think about is if you're in a role that you're limited on your income potential, and a lot of people that I see do a role, have a family, and they're generating an income, but there's probably a time frame when they can last in that role. you might be in a labour intensive role, and at the end of the day, that's great while you're young and healthy, but when you get older, it gets to a point where it's difficult to go to work and do that type of work. So looking at the trade-offs of what else is the other opportunity for you, I hark back to a time when I was chatting to a young couple in Launceston, and he, a few, I suppose, injuries and illnesses was just making work really hard.
Yeah.
Having a discussion, getting under, lifting the bonnet in terms of their circumstances, realised that the role that ideally that individual wanted was to be a horticulturist.
Right. Yeah.
And they're in a labouring role.
Yeah.
So it's about then, okay, well, how do we get you to that point where you can start developing your skills to move into a different role, and also hopefully increase your income earning potential. And that's a really thoughtful thing to think about when you're trying to get ahead. So first of all, going to university is a good idea. Young person, you don't obviously earn much income while you're at university, but the idea is that you spend your time there to skill up, to move yourself into a role that can generate a higher income. So really upskilling yourself.
So example I was thinking of when you were talking about physical exertion. So a couple of clients of mine, landscape gardeners, the discussion centres around, okay, they realise that they can't keep doing this physically forever.
Yeah.
There is a time limit to how much they can physically do on their body. So the discussion becomes a slightly different investment discussion, but not necessarily universities talking about, okay, machinery for, am I ready to buy a mini excavator? Am I ready to buy some other pieces of equipment for the business, knowing that may facilitate a longer term involvement in that industry without relying on them physically lifting everything and doing all the digging. So it's an interesting discussion because on the one hand, I do see a lot of people say waste money on the toys for business and like to have the latest and greatest. But then challenge on the other side of the challenge is to say, well, if we're playing a long-term game, then it might be an investment for their future. And then they might be able to supplement that with other labour that they bring in for short-term projects as well. It's a good discussion.
Because if we're talking about wealth creation, one of the biggest levers is obviously time, time to be invested, and being able to have the ability to use some of your income towards it. Rule of thumb, and widely in the industry, I mean, if you speak to different planners and different advisors around, they all have their different play on what you should have. I have a view that you should try to save at least 15% of your income that you earn. And I try to make that as easy as possible for most people who I see, because part of it's delivered by your employer with the super guarantee payment. So when there's only probably a gap of 5 or 6%, you can actually start to fund it, and it starts to become a reality. If you said to most people that you've got to put away 15%, so we don't have 15% to put away. But so just rethinking it.
Well, if you take an example, someone on $50,000 a year, say, so you're talking about 5% of that, so $2,500 a year, so it's $50 a week. So you break it down, and then say, okay, I could probably cut back on 5 coffees and run something else. Get the $50.
That's right, and get the habit changing, starting to invest, and the beauty of that is when you start to see an investment grow through compounding, actually becomes quite.
That's right. I was only talking to a client yesterday about that, and they're probably in their 50s, and they've emigrated to Australia, so they don't have a lot of super behind them. But I said, look, you're probably another 15 years, they're trying to continue to work. I said, don't underestimate that you put an extra $50 a week into your mortgage. In 5 years' time, you wake up and you pay off 7.5, 10 grand off your mortgage, and without you batting an eyelid. So that's not necessarily compound interest in that example, just that compounding effect of chipping away at small chunks on a regular basis.
So increasing income, I suppose, and then it comes down to, I suppose, my view on investments. There's different styles of investments, and what's the focus of what we're trying to generate? Is it income or is it capital from that point of view? And they have different return potentials. So we did talk about this on another previous presentation, but to sort of recap, cash-like investments like term deposits and so forth, we really focus on an income return, whereas shares and managed funds and properties we tend to focus on the capital gain, and it's over a longer term that we tend to invest.
Yeah, so there's the two elements in there, the cash component or the income, and then there's a capital growth.
So the question is, when you're looking at investments, what are we trying to achieve? Is it a long-term capital gain, or are we trying to generate a passive income over time as well?
Yeah.
And as you growing wealth in your younger age, probably the capital growth is the focus. But when you get older and you start to wind back your working life, you're wanting to rely more on passive income. And so, for example, people in retirement phase like to know that they've got income coming in and got that regular support. So,
and sort of another example in that space, I was talking to a client the other day, they had investment property outside of Melbourne. If you look at purely on income terms, it was quite a poor return, probably 2 to 3% net after costs. You go, well, I don't know, it's pretty low. And their counter argument was that, okay, we believe that that's sort of next growth corridor in Melbourne's sort of growth, and therefore it was firmly in their mind that it was a capital play to get the capital growth. So as long as you're clear in your mind what you're doing it for, and then you can sort of plan accordingly.
Yeah, and that's the basis of why they've chosen that investment. So with the expenses, there always is a focus on reducing expenses, but what I try to do from my point of view is identify an amount that can be saved. So I don't want people to sort of swap the things that they like doing in lifestyle and go out for their cappuccino or their latte and not do that. I want people to do that, but within a thoughtful means. So not swapping your cappuccino for instant coffee. That's probably a bad outcome. But just starting to focus on ways that you can reduce your expenses and save. And so what I look at is also your bigger ticket items. Where can we save money, especially in insurances? Because insurances, if you ever add up your insurances, you'll shudder with the cost of it. So look at your general insurances, look at your home and contents, chat to your brokers, arrangements in that, and see if they can get any better deals in place. The other piece that I look at, which is often a set and forget for a lot of people, is life insurances and income protection. You've got limitations there, but it's always good to see how can we structure that better to get I suppose, reduce the cost of it. With the main aim to try and use those funds that we're saving towards another circumstances.
So on the insurance one, sort of another thing to check with your broker or your underwriter is deductible or excess. Sometimes depending on the nature of what you're insuring or where the market's at, you might go make savings. So you might be you pay the first $250, the premiums, $500. But if you pay the first $500, it might be $400 premium, something like that. And you just trade that off and say, well, save $100 a year. Yes, there's an extra risk of another $250 you can make a claim, but like everything insurance, it's a risk reward type of process. You're sort of managing your head. So I always say, don't skimp on your key items like your house. You need that insured. But if you pay the first $1,000 if it's burnt down, it's not the end of the world. But don't insure it for $200,000 if it's worth $400,000. So that's just no point having that insurance almost. And the other one was interest expense. So certainly in this current environment, it's worth having a conversation at least annually. I encourage people with their bank, and not to screw people down, but just to there's no doubt in my mind that telcos and banks often offer a more attractive product to new entrants to their customer base than existing customers. And it's worth having a conversation with both of those once a year, saying, I noticed there was an introductory deal of X, either with them or with someone else, and what can you do? Can you match that offer?
And not to be hard on the banks, but they don't offer up interest rate discounts.
No.
But if you do ask the question, and one of the things I think is really useful is just, if you've got a personal banker, shoot them an email, ask them a question, and invariably they want to retain you as a client, so they'll hopefully look after you. And if not, look elsewhere. In my view. But with that also structuring your income protection insurance and so forth. One of the things that I look at is, do you have a backup plan, like a 90-day or a 3-month backup plan in savings, or in your holidays, or in sick leave and so forth? Because then we can start to think about how we structure income protection, and income protections can be quite expensive. But you can actually reduce the cost by 15 to 20% if you delay when you need to access that. But the trade-off is having enough fallback position to get you through a hard time.
And you talk about having that sort of, say, 9-day reserve. One of the other great sort of tips is to have some form of reserve sitting in an offset account. And my preference is offset rather than redraw. Just from a tax perspective, it works better if it's an investment property. And it just maximises your interest. So if you're paying, say, 3.5% on your investment loan, then effectively by having $1,000 in your offset account, that gets offset against your loan balance, and therefore you're effectively earning 3.5% on that $1,000. If you rock up the road to get a term deposit, and as my state's offering 0.9, something like that, as a headline rate, so you're not going to get anywhere near 3.5% on that term deposit.
No, and it's really relevant right now because we're in a low interest rate environment. And if you look at the longer term forecasts, I don't believe that we'll come out of it within 5 years.
It's going to be here for a while. The pundits are saying.
So it's a good time to pay down debt, in my view, and also credit's cheap from that point of view. So you've got to balance.
But don't get caught up in your credit card, credit cheap.
That's right.
Cycle as well.
So with the offset accounts, I love that idea as well, and it's a great example. If you're not as well disciplined, I often think that the redraw is probably better.
There's a bit of a hurdle
to get through.
That's true.
And another one is to put it with the bank and then cut up your access card.
I did see people who have sort of a tendency to dip into it, and they go with a separate bank. And put it in an online saving that they can't see on the internet banking from day to day, and the back of the mind's there, but they can't. And then you cut up the card that they can't go to the ATM.
Cut up the card, so the ATM's not available. You have to walk into the bank to actually get funds out, and it just changes behaviours. So lots of little wins there. So just to finish up on there, reducing expenses is important, and we've showed some ideas around that, but don't remove things that are really important to you. And as I said, don't cull something that's a necessary useful tool, such as income protection, but think about restructuring it from a point of view where you can save a few more dollars from that. I thought today I would just sort of talk about the ability to save, and probably bring you into this, Michael, in terms of you're a young couple and you've got the ability to save, and we all know how hard it is to get that first deposit for your home. But if you think about wealth creation from that point of view, getting into your first home is your first major investment, and it's a really big milestone for most people from that point of view. Sometimes you can get assistance through your family members or from an inheritance, which is great. But it is typically your first investment. And broadly, that can be your number one investment for a very, very long time.
It's for most people still.
And so when I look at wealth creation, with with young couples especially, I look at, okay, well, if you've got a big debt and you're paying that down, let's just use that vehicle for the time being to get you ahead.
Yeah.
There's points where you go, okay, well, you've got enough equity now, we can start looking at that other investments. But like the offset account, it's a really still a useful vehicle if you look at the pre-tax cost of servicing that debt.
Yeah.
So never write that off. But I was just looking at a statistic, and this is another one from Michael who likes his statistics. But just show from the Bureau of Statistics the average level of total wealth for middle Australians. And people whose wealth is between the 40th and 60th percentile was around about 565,000.
Yeah.
And that was the most part of that was through your home.
Yeah.
Home.
I learned something new. The average home in Australia is worth 435k.
Yeah. Which is 77% of total wealth. So
family wealth, isn't it?
That's right.
Family house still, and Australia has no doubt a love affair with property, and I can see that continuing. There's a bit of doom and gloom in some circles, say in Melbourne or wherever, about property prices, and yes, they'll shake around a bit and shake around. But I'm a believer with the long-term stats in Australia still have a culture of believing in property. So you're going to have that underpinning once net migration goes back to pre-COVID levels. You're going to have that fuel in the construction in some of the major capitals. So it might be a bit of a up and down in some of those apartment style developments, but if you've got a bit of dirt attached to your home, dirt doesn't go down in value. No, they're not making any more dirt as far as I can tell.
Yeah. The only ones I see fluctuate, obviously, notably the properties in Gold Coast and the Sunshine Coast tend to fluctuate quite a bit.
Yeah, I mean, Sunshine Coast is a good example, but I was chatting to a real estate agent last week. Sunshine Coast, in our minds, is a discretionary spend, like apartments and stuff like that. They can't get enough stock at the moment because of COVID. People are going, okay, I can work in Brisbane but remotely work from Sunshine Coast. I'm relocating to the coast if I'm going to be working remotely. So they've got, regional areas that are underpinning demand, whereas 3 months ago I said, well, Sunshine Coast is going to really struggle because, where's the people coming from? So, you always find little surprises pop up through these changes.
Especially just if we anecdotally with Tassie and I suppose our region here, you are hearing anecdotal comments that the market is still quite buoyant. For interest.
Yeah, one of the stats came out yesterday, I think. Hobart's up 5.1. I think other capitals, outside of Melbourne and Sydney were either holding their own or up. I mean, it's small sample size, but it's not falling off a cliff at this stage. I mean, the commentary is still there about post-JobKeeper. The banks are doing a lot of support at the moment, heavy lifting. And we've heard a couple of, I suppose, bank CEOs come out and say, if you're thinking about downsizing, go now rather than wait for it to hit it down the track, which is probably sage advice if you are sort of overly geared in your sort of investment property or your home. So some sage advice there, but I don't feel like the sky's going to fall tomorrow that you need to make a rash decision.
So I thought just with investments, there's many factors that affect investments. That's why I sort of wanted to talk around about the property and being that an investment. And at some point in time when you've got enough equity, it makes sense to do other types of investments as well. But it also comes down to your appetite for risk, what you're comfortable with, and then identifying the appropriate vehicle for how you invest. And there's quite a...
So the appetite for risk... Oh, sorry, you're going to go into that? Oh, you go to the next slide because I think you've covered some of my comment by that.
I'll let you talk through that.
So to me it was about appetite for risk in the context, as an example, if you're saving for your first home and really the worst thing that could happen would be for you to lose some of your capital value. Don't put it in the share market, because by its very nature, there's short-term wins and losses. Yes, you might have, been able to double your money if you had some shares in Afterpay, or tripled your money, I think, back in March to what they are now. But I don't want to sort of make light of it, because some people have made good money out of that. But I could have gone to a casino and had a good night on the tables and won good money there. But that's a high risk strategy, and it's fine if you've got that discretionary spend, but don't make it that's your life savings ready for your dream home. And all of a sudden tomorrow, which could happen, Afterpay, something happens in the world, and their share market price collapses. So
correct, and there's always that risk as well. So choosing the type of investments, if you've got good guidance around your direct shares, that's one avenue to invest.
Yeah.
If you like to have more of a managed approach, there's different vehicles that you can choose to do that. And there's more active approaches, and there's what we call a passive approach as well, just variably lower costs in that approach.
Yeah.
But as people's knowledge is increasing, obviously the knowledge of how to access direct shares is becoming well known.
Yeah.
And people like to dabble. So
they do. I mean, that's another Australian strong cultural element that people don't mind in a bit of a punt, basically, and that can be in business or backing your footy team, whatever it might be. Backing Mick Malloy's multi. But yeah, we've certainly seen through this COVID period, and both in the States and Australia, that the more people going to this direct share type of arrangement, and as you've listed there, your E-Trade, CommSec, NabTrade, common platforms that people use. I was watching for the other night, and there was Jenny said, I can't remember what it was. It might have been IG or something like that. I said, what's that? So we Googled it, and it was another investment platform that was sponsoring a Melbourne Footy Club.
Yeah.
So there's plenty out there.
Yeah.
So that and relatively cheap cost. It's I'm with NabTrade. I think it's $20 a throw for me to buy or sell directly on the ASX. So it's not huge dollars you're playing with.
And you can sit at home on your laptop and access all the information. There's a lot of information available.
That's huge, overwhelming, and that leads us to the managed funds, because there is such a overwhelming amount of information, and often it's contrasting. Is that the right word? It's confusing sometimes, because you do get different opinions. So people they go managed fund and say, right, it's all too confusing, I'm going to trust it to an expert, which is fine. That's one strategy. You can trust it to an expert, or you can trust it to a Vanguard, one of those sort of large sort of managed fund type of people, or you can trust it to a managed fund that is more active, that can do the analysis for you and pick the next stock in a rise, or you just go and do your own research, but I think follow a handful of people that you trust their opinion on. Don't try to Google everything and find out what works, because you just end up in this confused state. And it's like everything, have a strategy. Like what am I in? Fortescue. So I was lucky enough to buy them about 6 months ago, and the share price was low, and I was chatting to a friend of mine last week, and their price is at $19. So it's over doubled. And I said, I'm just not sure if it's an iron ore bubble. He said, well, if you're thinking it might happen, why don't you get out of some of that stock now? And it was just good advice for me to reinforce, to say, well, as you always say to me, you never pick the bottom, you never pick the top. So, you've just got to sort of hedge your bets, or take some money off the table every now and then.
Yeah, and if that's something it doesn't sit well with you, then you can actually involve, I suppose, a manager to assist you with that process.
It's not everyone's like us who likes to look at a balance sheet and work out what the price to earnings ratio is and what a return looks like.
That's right. Yeah.
Some people do it, and some people go, oh, that's just overwhelming. I have no interest in that.
So there's a lot of information available, look, that's a wider conversation if you want to do that.
And I like what you said there, that no more than 12 to 15 shares. I think it's a really good rule of thumb.
Yeah,
more than that, you just start to get.
I think you're replicating an index then. So then,
And you pointed out, just to refresh people's memory, an index fund essentially would say, as an example, match itself against the Australian top 200 stocks and just replicate that. So whatever that average is doing, just follows the averages. That's definitely an index fund.
Yeah. And then if you're wanting to get someone who backs their judgment a bit more, that's when the active side of things.
Active manager.
But you do tend to pay a little bit more for that.
Yeah.
Just thought I'd run through just some ideas just to wind up in terms of a financial plan and what that is and what you should think about. And just this example is just a young couple. Things that we think about is your home ownership, cost of living. Is there a need to fund school fees in the future? Is there potential relationship issues that we need to consider? And also how we're looking out for your parents. And just to understand, it's not all about a solution. It's about understanding, I suppose, your family and what's important in your life. So then I'll go through, from my point of view, just thought provokers that can sort of help young people think about how they can improve their I suppose, their ability to invest.
Yeah.
And as we've touched on, education, improving your personal savings plan and your costs, thinking about your home loan and how that's managed. Are you getting the best interest rate? Are you complacent with it? Are you targeting a pay down over a period of time?
Yeah.
And so forth. Then other things that we look at is contribution strategies into superannuation. And when you're younger, it's probably not as necessary to start funneling money into superannuation, but it's a good idea to start doing a little bit of that. And so salary sacrifice can be assisting there. Other things we look at is depending on the valuation of the car that you want and your income, what's the best tax effective situation to have that car?
Yeah.
Do you have a personal loan? Do you have it through a lease arrangement? And those type of things. And I mean, rule of thumb, there's good thoughts around, when that's effective for you, and that's where your accountant or your planner can jump in and talk you through that. Credit cards, make sure you think about how you pay those off regularly.
Yep.
That can be an extra around the neck.
Oh, definitely. Yeah. That's one thing. Definitely the compound effect of not paying your full amount off when the due date is bad news for most people.
Bad news. And it's hideous when you look at the pre-tax cost of it as well.
Yeah.
And the other pillars I've always looked at is first base. Let's look at how you're protecting your income. How's that set up? And do you have a useful life insurance in place? And I always put just an affordable one, because at the end of the day, it doesn't have to be bigger than Ben-Hur, but it just needs to be suitable for your circumstances. So running through that. And then I've gone through probably a less youthful financial plan.
But still youthful.
You're still youthful. A couple in their 50s thinking about retirement, trying to get their game plan ready to get ready to retire early, hopefully, with the main plan of when COVID back to normal, they can travel and do all their things. So it's the same thought process, but start to think about how you can develop your skills to develop a higher income and improve your employability from that point of view. Reducing your personal costs and the ability to save. So there's similarities in both age groups. But then talking about, I suppose, the retirement and when is that date? And as I said, one of the bigger relievers I always find is time. If you can delay retirement for 1 or 2 years, it helps you build up more capital. It's less capital you need to draw down to fund your retirement over a period of time. And that can be a really strong decision making
Mm.
time frame for when you plan your retirement.
Yeah.
The other piece I look at is one of the biggest bugbears I have is when I see couples in around about the 55, they've still got a reasonably large debt, and how are we going to get rid of this before you retire? And getting a thoughtful strategy around that, and having that align so it's paid off, so you're debt free by retirement. Really important for me. The other piece is just start having some initial thoughts around, will age pension play a part in your retirement? Because that becomes a really good tool to provide your first basket of living expenses. And a lot of the clients that I see when they're funding retirement will use part of their own nest egg fund, but also we try to maximise their entitlements to age pension. And very that changes over time as well. So it's a thoughtful piece to think about.
Good tips.
Question we had, and I thought I might throw this one to you. This came through during the week.
Multiple entities. So it's talking about structures. So in rough terms, where we've been today is talking about two types of structures, pretty much individuals, which is not really a structure, it's just the default position that you accumulate wealth in your own names, husband and wife, for example. And then the other wealth accumulated is superannuation. All superannuation really is a sort of a forced savings plan that's supplemented by your employer normally with the 9.5%. But at the end of the day, it's still your money. It's just that there's conditions of when you can access it. And it's a very effective tax tool because it's 15% tax on the way in, and there's some tax benefits when you retire in terms of having sort of effectively tax-free income. So they're the two main structures. Then another structure that some people start to use at some point in their journey is a family trust or a discretionary trust, which is a mechanism to accumulate wealth. Remembering trust law really goes back to sort of old English law, where a lot of inheritance assets were passed down from generation to generation. And so the same principles apply, that asset is held by the trust, and you have beneficiaries of that trust who can then make use of the capital, which is described at the start, or income. So you can have two different streams effectively in a trust. So then after that, then for business people, then you have company structures and stuff like that. There is a bit of commentary at the moment that with some of the restrictions in superannuation, whether you build wealth outside of super as well, and what they call inheritance companies are starting to have a bit of commentary. Really, that's for your high net worth type of individuals. They're the typical structures that you do see. Tossing some numbers around how multiple entities can be beneficial. It's a matter of just looking at your individual tax situation. And at the end of the day, you either got superannuation in a low tax environment, you've got individuals with what they call a progressive tax scale. So the more you earn in different brackets, the extra tax you pay at what they call marginal level. So every dollar you earn at the top marginal rate, effectively you're 45% plus Medicare levy. And comparing that to trusts, all trusts really allow you to do is to spread that income amongst a range of beneficiaries. And then you've got companies which are, if it's a trading company, their flat rate of tax is 26%. So throwing the numbers around, it really depends on a case by case. It's just crunching those numbers on a pre-tax and post-tax basis of having different structures where you hold your wealth. And comparing that with super, where it is definitely a tax advantage, but trading that off against the fact you can't touch those, have access to those dollars until you retire.
To make preservation.
Yep. Hopefully that's answered the question. without it being, I can't give no exact answer depending on your personal circumstances. All right.
That's us done.
That's done. Thanks, Andrew.
My pleasure.
As I said, we'll kick these off again on a regular basis. So thanks for tuning in for Wealth Creation. We've recorded this as well. So hopefully those who weren't tuning in today can watch it in your own time. And as Jenny found out on the weekend, you can watch stuff at double speed and save half your time. All right. Talk soon.